What's up, everyone? It's Scotty with Money Investing. In this video, we are going to talk a little bit about the Federal Reserve and Jerome Powell's upcoming FOMC meeting in about 12 days, 6 hours, and 32 minutes. So we've got, it's right around the corner. We've got, a lot of things happening between now and in the next 12 days because we've got big tech earnings coming out next week. We've got, GDP numbers coming out. We got consumer sentiment, retail sales, not to mention the Fed meeting. Incredibly important for the markets as well. And we'll learn from Jerome Powell, and he's only going to be on one mission, and one mission alone is to make sure that inflation continues to come down even further. So that's going to set the path for interest rates moving forward. So very important. And in this video, I want to break down a couple of different research reports that suggested what happens to the market after the last rate hike and between the first cut, and what is the average timeline between the last hike and the first cut as well, and talk a little bit about the bond market as well. So hope you guys enjoy this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. There is a 16% annual discount available if you want to take advantage of that before it expires at the end of this month. So this right here is a tweet from Mohammed El Arian, and this actually came out this morning. He mentioned that yesterday's heavy day of Fed speak was consistent with the market's consensus forecast that the central bank will hike by 25 basis points in 12 days' time. And beyond May, however, markets are still looking for cuts in 2023, while the Federal Reserve officials continue to signal unchanged rates. So right now, as it stands, we are still very much in a discrepancy, or in other words, market conflict. So 84% of Fed funds futures expecting the Federal Reserve to hike interest rates by another 25 basis points. And that's going to put our range somewhere between 5 to 5.25%. And many market participants, many economists, many investors believe that is indeed going to be the terminal rate for the Federal Reserve, and they are going to signal a pause on May 3rd, right, in 12 days' time. However, this is where the disagreement happens. Jerome Powell, the Federal Reserve, and Fed members have all pretty much mentioned, and in their SEP, the Summary of Economic Projections, there's not going to be any rate cuts this year. Literally, this is what he mentioned in the recent FOMC press conference as well, talking about there are not going to be any rate cuts in 2023. Yet the market continues to price in at least 2 rate cuts in 2023, not to mention the several rate cuts priced in 2024. So this obviously is a big discrepancy. Now, the Federal Reserve's tone can change because we learned from the, raising interest rate scenario, because the Federal Reserve was quoting this inflation being, quote, transitory, and that we know how well that played out. And they quickly flipped from not raising rates to immediately raising rates to getting up to 5.25%, and along the way, breaking parts of the economy with the banking crisis as well. So that tone can change, can flip. But a real question is, even if the Federal Reserve does start cutting rates, and first they pause and they start cutting rates, how is the market going to react? So according to Austin Pickle, investment strategy analyst at Wells Fargo, any pop from indicators that a monetary tightening cycle is over is likely to be short-lived, is what he mentioned. He produced a chart below which shows the S&P 500's performance around the end of the past 5 rate hike cycles and how it fares up until the barometer's subsequent notable low. So this right here is the line where the Federal Reserve is not hiking anymore, I believe. And you'll notice the S&P 500 value and how it has seen a bit of a rally, but then eventually it has come down. That's happened back in 1989. It's happened back in 2000. It's happened back in 2006, and it's happened back in 2018. The only exception was 1995. That's the one in yellow where there was no landing scenario also played out. So the chart illustrates that since 1989, stocks have rallied after the hiking cycle headwind has removed. In other words, once the Federal Reserve was done hiking, stocks have rallied historically, though outside of 1995 no landing scenario, the rally fizzles out and stocks are dragged lower as the macro environment deteriorates. And if you go back to what really transpired during that time, 2018, over-tightening U.S.-China trade wars. 2006, the housing bubble bursting and melting up of the financial crisis. 2000, we've got the dot-com bubble, overvaluation, significant optimism and greed in the market. And 1989, we're also dealing with great inflation back then, Paul Volcker, and of course, everything with the recession that followed as well. So with the exception of 1995, we've seen the market rally pretty much get fizzled out. In other words, it's been very short-lived, to say the least. It has rallied, but it has fizzled out. Indeed, Pickle reckons much of the S&P 500's 15% bounce off of the October lows already reflects the expected removal of the uncertainty about additional Fed rate hikes. And so, as markets refocus on deteriorating economic and earnings realities, we expect the stock rally to struggle. Furthermore, any quick move to cutting rates of this kind, some in the market are hoping for, will only occur if a dire situation already exists, and the average time before the Fed's last rate hike and the cut is 6 months. This right here is another really interesting chart, which pretty much shows you the time difference, the average time it takes for the Federal Reserve to start cutting rates after their last hike. And the average is 6 months on average, right? That's the average, but we've obviously seen time periods where it's taken 2 months to as little as 1 month. So you can go back again, 1974, 1980. This right here is 1984, 1987. They started cutting rates, but we also know that that was a big fault from Paul Volcker and from all the Fed members back then, because inflation, what happened was spiraled back out of control, and we had that double top in recession, double top in inflation. Of course, we had double dip recession back in 1970s, 1980s during the Great Inflation as well. So this right here, if you take that out, then I think the lowest is 4 months in 1989, 5 months in 1995, and then 6 months in 1970s and 1980s as well. So average 6 months. And it's taken even as much as 18 months in 1998. So first cut pretty much happened in September of 1998, and last hike was in March of 97. With more recently, though, it took 7 months for the Federal Reserve to start cutting rates after the last hike. So if you go back, right, if we take into account 6 months on average, then according to this, if we do pause in May, 6 months from May is going to be probably around December time, November, December time, when they should actually be start cutting rates. So even if markets analysis of rate cuts is right, the average time is 6 months, and we're expecting rate cuts starting in September. So we're just a little bit few months shy of what the average number looks like. But of course, the average doesn't mean that it's going to happen. It could be lower, it could be more. Now, while 2 months from the last hike to first cut is obviously not unprecedented, such action would likely require the stock market crash like 1987, the current banking turmoil to deepen like 1984's, and also a recession in the midst of one of the great interest rate spikes of all time, 1980s or 1974, classic Burns blunder, where the recession and inflation collided with American President Nixon and on the verge of resignation, creating complete governmental chaos as well. Now, talking a little bit about the bond market, we do also have equity markets and the bond market kind of disagreeing. Bond markets have been pushing higher, and so is the stock market. So that's the correlation that's now a little bit more on the positive side. Especially when it comes to the yields. I'm not talking about bond prices here. I'm talking about the 10-year yields, mostly 10-year yields, and then, of course, all the other treasury yields and the equity prices as well. And right now, as you can see, it is generally reckoned by equity analysts that the markets is so far dismissing any concerns about the chance of a U.S. debt ceiling not being raised in the coming months. Remember, we are right now under extraordinary measures, and I think first week of June is when that will run out, and we could start to see some government shutdowns. And the government technically defaulting on its obligations possibly as soon as June. However, Lawrence Gillum, Fixed Income Strategies at LPL Financial Research, notes the bond market is paying attention, and you're seeing the spreads pretty much drop pretty significantly for T-bills maturing in May versus T-bills maturing in July. So pretty much maturing in July, the concern is that the U.S. government is not going to be able to pay the principal back to T-bills maturing in July. And as a result, the yields have pretty much skyrocketed because of the higher risk they carry, right? Remember, bond market is nothing but it's also a barometer of risk, right? How well is risk positioning itself in the economy? If their yields go up, there is expectations that there is high risk in the economy, and yields right now are pushing out, especially for T-bills that are maturing in now under 3 months. So I wanted to point out some of the realities in the situation, and I know that there's a lot of optimism, there's a lot of bullishness in the environment. There is definitely a lot of momentum in this rally that we're seeing, but I also want to point out that the economics, in other words, the economy and the earnings are definitely weakening. There is a ground shifting underneath, and at the same time, the bond market's signaling something that I feel like not a lot of people are paying attention to, and not to mention that the market's pricing in significant cuts, especially 2 to 3 cuts in 23, where the Federal Reserve has pretty much said no, and the average time from last hike to first cut is about 6 months. So at some point, there is going to be our path is going to cross with the reality, and that's where I think the market will struggle to find some proper momentum to break to the upside further. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. What do you think? And don't forget to subscribe and drop a like on this video. Link to our Discord and Patreons down below. 16% annual discount available till the end of this month. And as always, happy investing. I'll see you all in the next video.